Assalamu alaikum again, everyone, especially those who are joining right now, and welcome today. Thank you so much for your interest in today's webinar. We realize that your time is limited and precious, so we appreciate you spending your time today with us at this webinar. My name is Shafaq. I'm an investment advisor representative at ShariaPortfolio, located in Austin, Texas. So today's webinar is about a topic that's on everyone's mind, inflation. As you all know, the pandemic has disrupted global trade and supply chains, which has caused delays in manufacturing and production and skewed up supply and demand. This has given rise to concerns about inflation. Do we have inflation today? Do we not have inflation? If we have inflation, how do we counter it? What are the ways to get ahead of inflation, especially in this world of investing? These are some of the topics that will be covered today in presentation. And let's get started. But before we do so, some standard procedures. The disclaimer: all ShariaPortfolio webinars, including today's and content, is for informational and educational purposes only. If you do need personal consultation, please feel free to reach out to us at info@shariaportfolio.com or call us at 1-888-HALAL-STOCKS, and one of us licensed professionals will be happy to reach out to you and address all your questions. A little bit of a reminder that we do plan to have a Q&A session at the end of the webinar. So please submit all your questions in that question box that you see on your screen, and we will try our best to address all your questions. Without further delay, I would like to hand it over to Aliredha Walji. Ali is quite a bit of a content expert in some of these topics. Aliredha Walji is the VP of ShariaPortfolio USA, and I will be handing over the mic to him in a bit. Aliredha, it's all yours.
Thank you so much, Shafaq. I appreciate you introducing this topic, a very pertinent one. I'm sure you all have been hearing this in the news. Almost every single day there's a headline one way or another. So, inshallah, this is relevant for you all. For those who are new to ShariaPortfolio, we are a full service wealth management firm. And as you've heard, my name is Aliredha Walji. I'm one of the financial advisors. And we'll be more than excited to kind of present this information to you. We've tried to come up, it is a technical topic, as you guys can imagine, but what we are, our intent here is to kind of dilute the information, or I should say, present it in a way that is more relatable, because we want it to be, from a perspective of an investor or a consumer, right? Those are things that you might be thinking about. And then kind of looking at, well, what are some tips and some suggestions that you could consider doing in your own personal portfolios, or if you wish to discuss any of those with your financial advisor, we can always discuss that with you and come up with a game plan for how to kind of stay ahead of the curve with concerns like inflation. Inflation is just one of the concerns that people may be having on the back of their minds. So let's dive in and talk a little bit about what is inflation. And I think describing the definition and talking about it will help us kind of understand what is the beast itself that everyone has been talking about. So inflation is basically, on a simplistic level, just referring to the rising prices of goods and services over a specified period of time. It is a general rise, in things that people buy, or services that they, whether it's a good or a service. So I like to look at groceries, right? Because we all eat, we always buying groceries, right? And I'm sure many of you may have noticed, and I used this example in one of our portfolio meetings, and they were having a laugh a little bit about it. But I like my blueberries, and I've noticed the cost of blueberries has been going up. I also like my coffee, and that too has been going up. So what's causing some of these things, and some of the subtle ways retailers are implementing those changes are in things like toilet paper, right? Or they might be changing the packaging slightly, or reducing the ply and things like that. So it kind of appears as though you're buying the same thing, but essentially they're reducing the content but maybe keeping the price similar. So it's tricky things that retailers have had to adjust in this whole COVID environment. So basically what's going on is the purchasing power of that same dollar that you used to spend buying whatever it is that you're looking to purchase, that loses the strength, and so the value kind of comes down. On the other hand, the opposite of inflation is something called deflation, and deflation is a decrease in the price of goods and services. And so, how is inflation measured? Inflation is generally measured by something called CPI, which is the Consumer Price Index, which is basically the average change in prices of things like food, clothing, housing, and transportation over a period of time. And core inflation is something that the Fed uses to kind of understand the dynamics in the economy, and then come up with certain measures that they might consider putting into place to counter the effects of inflation. So in that sense, it's a little bit different than just the CPI, but it's measuring long-run inflation. So something that's more short-term, and you've probably used or seen the word transitory being used. Those things are excluded from the Fed's impacts of what they're planning to do. What they're more concerned is there anything longer term? Because if it's something short term, people can live with a little bit of increase in the cost of goods or services. But if it's going to be sustained over a longer period of time, or if there is like food or energy prices, which they don't typically look at, but that's something that a consumer might still be concerned about. So that's where the differences lie. And then let me go to the next slide here. So I don't know if I skipped. So are we experiencing inflation, right? That's a question that someone might have. And maybe I did skip another slide here. One sec. So on this particular slide, what we are trying to display here is that the difference between the headline consumer price index versus the index that excludes food and energy. So the trend is generally upwards, even if you don't factor in food and energy. But what you'll notice is that the 12-month headline inflation rate was 4.2% in April, which is seen as the highest level since 2008. In May, it actually came in at like 5%, which is even higher. And so, given that the 12-month rate through March had been, around 2.6%, this is an indication that there is a sizable surge or an increase in the CPI inflation. 12-month core inflation also went up to 3% versus 1.6% was the previous kind of baseline measure. And CPI also went up from what was previously to 0.3, it went up to 2.3%. So why is this a relevant topic, right? That if you take a step back, the COVID pandemic affected the United States just as much as it affected other countries, but specifically in the US, the central banks slashed the interest rates to near zero and began to aggressively absorb assets to prevent another financial crisis. They had learned in 2008 that if they do not step in sooner and with a large magnitude of aid, that would risk putting the economy in a recession. And so as a way to counteract that, they decided that they are going to purchase a government, they're going to purchase debt, and they're going to want to keep the interest rates low to finance, and also there's the whole stimulus that was being offered to households and businesses. So that was to make sure that the engine keeps running and there is no pause somewhere. The Fed has been consistently stating over the past few months that its goal is to keep steady the rates at a very low rate, and until they can see substantial progress that's being made. And how are they measuring progress? Through unemployment, which is one of their main objectives, is to make sure that unemployment levels are at acceptable levels, and that the inflation that we are seeing is not structural and more just transitory. So those are the two main things that I can see that from their communication they're looking at. So going into what I found interesting is what Warren Buffett was stating, and he stated that there's going to be winners and losers out there. But for stocks, what he said is low rates make stocks look like bargains. The reason is that higher rates would erode more from a company's cash flows. And we'll talk a little bit about the 10-year treasury as well. So as rates go up, the cost of borrowing goes up. So companies that are more on the growth side of their phase, they might suffer because they're hoping that they're able to borrow at a lower rate so that they can finance different activities. So interest rates, according to Buffett, are to the value of assets what gravity is to matter. So I found this quote quite interesting. That's why I wanted to share it with you all. So what he says is interest rates are to the value of assets what gravity is to matter. Joking later, he said that if I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping. So what he's trying to essentially say is that cheap borrowing costs help households and businesses, hurt by the pandemic, and that if you are getting a situation where rates are lower, take advantage of that and purchase when there is a bargain out there. And as you all know, Warren Buffett is one of the ones out there who is the biggest proponent of the value investing, right? Which is buying when prices are low. So when rates are low, that favors growth. And so, that could be something that Rezwana will talk a little bit more on the second phase of the discussion, which is more on what are the recommendations. So right now we're looking at, are we really experiencing inflation? And as you can see, the cost of goods has gone up, 4.2%, compared to the period last year. And the current yield on the 10-year. So I did mention that, look, we'll talk a little bit about this 10-year treasury. Why is that relevant? So when inflation expectations rise, sorry, that skipped one slide there. So when inflation expectations rise, bonds become less desirable investments and their prices fall, pushing up the yield. So that's what's the interrelationship between the 10-year treasury and the bonds out there. However, optimism for an economic revival following the corona-induced lockdown that everyone went through, that along with the expectations for the high inflation gave rise to climbing yields. So you can see that we came off of a very low point. If you look at the 1-year chart here, we started around 0.66 in June, around June of last year, and it's kind of dipped to around the 1.5. Earlier today it went up slightly, but it's still around that 1.5 range. And so that's what's kind of going on the 10-year treasury side of things. The expectation has been rising due to loose monetary policy, low Fed rates, and the quantitative easing, while the economy is in the full potential. So I know I sounded a bit jargon there. So what is a quantitative easing essentially? It's a monetary policy where a central bank purchases government bonds or other assets in order to put money into the economy to expand economic activity. It's considered somewhat of an unconventional form of monetary policy, but it's usually when inflation is low and when standard monetary instruments that are used are not very effective. So that's when they decided to pump, the $120 billion per month asset purchase program came into play, along with the Fed keeping the interest rates low. So together they felt these would help kind of spur economic activity and get people out of the induced lockdown mode that put things at a standstill. So treasury yields can go up if the Federal Reserve increases its target for the federal funds rate. So if they decide to tighten the monetary policy, or if there is a perception, right? Because people react, the stock market generally is reactive to what is expected 6 months ahead, for example, right? And so if people are expecting that rates might go up, or if the Fed looks at the inflation figures and maybe unemployment has improved, then they're saying, well, we're achieving our objectives. And if we're achieving our objectives, then maybe it's, the economy is running too hot. We have a stronger economic rebound. And this was something that they were not maybe expecting. Then they would be more likely to raise their interest rates. But from the discussions that have been taking place, including their 2 p.m. Eastern time meeting today, what I came to see from their notes is that they are acknowledging that no doubt the vaccinations have definitely reduced the spread of COVID in the United States. And there is, there's strong policy support. Economic activity and employment have definitely strengthened. So there was a higher unemployment kind of starting out, but things have kind of gotten a lot better. But in their updated projections that they released today, 13 out of 18 officials from the Fed indicated that they expect to lift the short-term rates by the end of 2023. This was up from 7 who expected that in March. So it looks like much more of these officials are looking to consider tightening within a couple of years. So it's not something that's going to happen right away, because they don't want to spook the markets and cause people to react negatively right off the bat. But they are giving advanced kind of notice that, hey, we might start doing something in 2023, and there's a lot more of the Fed officials kind of looking at going for that type of approach. And so that's something that we're going to definitely be keeping in mind and seeing how things develop from here on out. I'm sure there's more meetings that they're going to have from now on, so it won't surprise me if there is any updates. But the tone has been consistently similar, in the sense that they're looking at this as a transitory event. They don't, they're hoping that things are going to work themselves out, and that slowly they can withdraw their support over time. But for now, even though they understand that by keeping interest rates low and continuing to with the central bank purchases of the treasuries at the level that they have been, it's definitely heating up the market, and they know that is happening. But they still feel that unless the other objectives are met, they don't want to kind of scale back their support. So that's something that has been a consistent message so far, that from what we are seeing. Commodity prices have been soaring, right? That's another indication that we're seeing, inflation, right? I mentioned earlier, groceries, but lumber has been one of the areas that have actually gone up. If you look at cost of building, right, the price for the plywood has gone up, and so what's happening is that the cost has added as much as, in some estimates, up to $36,000 additional for what would have been the cost for building a new home. And average selling price for homes is around $400,000. So this is telling us that there has definitely been a rise in the prices of commodities like lumber, copper, and some of these other things as well. Copper and some of these others may continue to still see some rise, and we're not saying that this is the rally in some of these commodities is over, but it would be something that someone would have to be cautious about, because after such a huge run up, some of the suppliers may be hoarding a lot more of the product, because if you're expecting something is going to go up and you are involved in that business, well, you might be inclined to store a lot more of the product. But what happens if the prices start to come down, which we did see actually just as of Monday this week? A lumber future contract traded below 1,000 per board feet for the first time since late March. It's still an elevated level, but it's kind of seen as a little bit more in line with the peaks that were seen in the summer of 2020 and early of this year as well. So the lumber prices can also give an indication of where the housing market may be headed. But so far, the demand is pretty high, as you guys have seen. People want to pick up properties in some of the most suburbs, moving away from some of the big cities as a way to have bigger size lots and things like that. And the demand has definitely outpaced the supply, so that's also causing some of the surges in these areas. Used car prices, right? I don't know about you guys, but or even if you're trying to get a rental car, right? I was traveling, visiting family, and I just decided against it. I was like, look, we'll just use a couple of cars if we can share, and not have to rent another car, because the costs have just become quite exorbitant for a used car, and people have been slashing their vacation plans and things like that. But also, if people are trying to sell their cars, someone recently was just talking to me, in that they're trying to go to the dealerships, and they feel like if the dealership is going to undercut them, they can take that same quote and say, hey, this is a used car shop. What are you planning? What are you willing to give me? And most places will give you above the book value, which is something unheard of, right? A car is usually seen as a depreciating asset, but that's happening right in front of our eyes because, again, it's a demand and supply issue that's going on. And part of the supply constraints on the new cars has been due to the fact that there is a limited amount of chips, right? You've seen the semiconductor demand, and the Biden administration has been talking a lot about how to boost production so that in the future we're not over reliant on other countries for uh, things that are essential to all sorts of things, whether you're looking at laptops or cars and other things. They're so reliant on these chips, and because of the lack of sufficient amount of these, it's causing lack of cars. They're idling plants. Car manufacturers are sitting idle because they don't have chips to put into this car. So that, again, it's a transitory thing potentially, and maybe it can kind of move out of this zone that we are in currently and get better as supply constraints kind of shift over time. Money supply has been ballooning. So this is another thing I felt might be important to highlight briefly. The Fed pushed the money supply higher by nearly $3 trillion through 2020. So if you haven't heard of this, this might not be something that's maybe often talked about, but the M2 money supply has been used to induce liquidity into the market, again, as a way to combat that lockdown. And if you think about monetary stress, it's related to both money supply and velocity of money. Velocity of money was in 2020, August, sometime around there, it was only 20% of the pre-COVID level. So what did the Fed do? They put more money in. And since then, because of higher flow of money in the system, if it is not if the velocity is not combated, then it will result in overheating of the economy. So the Fed does have a hand in influencing the money supply by also modifying the reserve requirements that the banks typically have to hold, for deposits against the loans that they give, for example. And by lowering the reserve requirements, banks are able to loan more money, which again increases the overall supply of the money in the economy. So the Fed does have a critical role in this whole money supply equation here. And so one thing that I found is that companies flooded the U.S. banks with deposits at the start of the pandemic, and the Fed lowered the interest rates to near zero. They launched the bond buying programs, in which allowed companies to raise funds at a low cost. The Treasury Department also made loans, and you can see there's a lot of moving parts here. So it's like a domino effect. One thing kind of leads to another, right? The Treasury Department also made loans, giving them to airlines, because you can imagine, they needed it at the time when nobody was traveling, and now things are slowly kind of getting back to a little bit more travel happening. Bank deposits have continued to surge, and some of the companies I was looking at, they're concerned that they don't want to be in a situation where they're spending, right, when there's a lot of uncertainty about what the future might look like. So they've been holding a little bit more cash. And so these are some of the dynamics that are going around, as it relates to money supply. And let's look at what the next slide here is talking about. And again, in continuation on the same theme, despite the surge, the velocity as a percentage of GDP has been sliding. This is an indication that households aren't taking on much debt and they're expanding their savings. So people who learned through some of the 2008 crisis, they want to be smarter about their money and not necessarily kind of spend more than they have available, because they've learned that if times get tough, they want to be able to fall back on their own savings as opposed to maybe relying on external sources to help them out. So for higher inflation to kick in, consumers need to be actively bidding up the prices of goods and services, and that's what's happened in cases of cars and homes, right? Especially in those two things, people are, when I talk to realtors, they talk about multiple offers and things staying less than a week and they're sold, right? So according to quantitative theory of money, inflation depends on the money supply and its velocity. When the velocity declines, It can offset an increase in the money supply and lead to deflation, which we mentioned earlier is the decrease in price, not the increase in price. The quantitative theory of money states that the general price level of goods and services is directly proportional to the amount of money in circulation. So if the amount of money in an economy doubles, then that also predicts that the price levels will double. So, it does also show us that by increasing the money supply, that can have an effect on, increasing the prices. Is there wage inflation? So this is one of the topics that is going to be watched more carefully, because wage inflation is one that is seen more so as a structural component of inflation. And what do we mean by structural component? It means that it's not transitory anymore. But obviously there has been some segments like hospitality as well as leisure industry, that was hit quite hard, right? The cruise lines were all sitting idle. Some of the areas like Disney, right, and some of these did not have as much traffic during the lockdown, but they have since kind of started adding more jobs. Demand for service workers is recovering, as we can see. And what's happening is that employers are starting to face a little bit of pressure in terms of raising their wages. And we did see some of the retailers kind of already increasing the wages, earlier, when they were reporting their earnings. So, it's not just the managerial workers, but the more labor, force is showing signs that there is small anecdotal evidence that wages have been rising. But again, it'll be watched carefully to see if this translates to something that's more structural. One frequent concern we've heard is that accelerating inflation could create the same sort of disastrous track that affected the fixed income market in the 1970s. So that's something that's going to be watched. The supplier bottlenecks that took place are seen as, those things might kind of work themselves out, and hopefully that will improve. But labor markets are different, right? Unemployment rate was at low levels and falling heading into the COVID shock. Instead of trending higher as it did in the 60s and 70s, labor growth has been kind of modest in recent years and building steam more on the upside. So instead of steadily kind of going up, it's been stable, maybe going up slightly. But labor markets are showing some slack in the quantity price. The capacity of production is much looser than was the case in the 1970s. There was a term called stagflation. So these are some of the things that would concern the investors or people who are looking at inflation from the perspective that is this going to be much more sustained, or are we seeing this as something that's just gonna work itself out once economy reopens and some of the supply bottlenecks kind of ease their way out of things. The next thing then that we're going to look at is, well, how much is the Fed going to tolerate when it comes to inflation, right? So they have an internal formula that they use for calculating inflation, which is called the deflator. Deflator is currently below 2%, despite CPI in April of 4.4% and in May of 5%. So a producer price index is an index that measures the average changes in prices received by domestic producers for their respective output. So its importance is being undermined by the decline in manufactured goods as a share of spending. Core PPI refers to the index of finished goods, and is generally because to make something, you're going to have different raw materials that go in. And so they're looking at the finished goods, which is the core PPI, and that's what economists refer to when the producer price index is referenced. Things like footwear or soap or furniture, they kind of fall into things that are measured within this core PPI. And so Fed has been consistent about, look, they're, if the PPI is, is under 2%, then they're okay with that, and they're willing to let it ride above that for a slight amount of time, because they acknowledge that yes, inflation is happening in front of our eyes, but they still are of the opinion that maybe it's not going to be longer term. That's the case. But if it goes consistently staying above that and overshoots that target, then they might be inclined to kind of tighten their belts a little bit more and put in some measures to bring things down and cool the economy down a little bit more. So again, it's this whole base effects that we've been saying, right? The base effect is that we started out at a low point at the beginning of the COVID lockdown, but things are slowly working themselves out as economy kind of bounces back from the induced lockdown that we had, and the bottlenecks kind of ease themselves. And so that's the main objective. And so as an investor, I'm sure you're thinking about, well, what should I be doing? Should I be concerned? Is there an action plan that we need to implement? And so that's where I think, this base effects has been mentioned quite a few times, is that if you're comparing from where we were last year, then obviously yes, things have gone up. But is this something that is a trend that is going to continue? There is a question mark, and there's going to be debates and discussions that continue to happen on this topic. So we're not here to say we have all the answers for you, but what we do have for you today are some recommended action items that investors, whether they're investing on their own, can take, or if they need help, an advisor can talk to them and kind of make some recommendations for them. So with that, I will turn it back to Shafak, and Rezwana can then give you some ideas on what the next steps of our discussion are going to focus on, the recommendations.
Thank you, Aliredha. Those were some very important points you just made, and the data and the numbers that you shared were very insightful. I hope everybody found it useful as well. So we're at the next part of our presentation about how concerned we should be about inflation and what are some of the ways ShariaPortfolio team is implementing, especially when it comes to managing the portfolios of our clients. So these are some of the topics that our next presenter, Rezwana Abed, will be covering. Rezwana Abed is an investment advisor representative at ShariaPortfolio. She joins us from the West Coast, sunny California. So I'll be handing it over to Rezwana, but not yet. I have a reminder to continue to submit your questions in the question box that you see on your screen, and we will try our best to address all of those in the end. Rezwana, I can't wait to hear what you have.
Thank you for the kind introduction, Shafak, and Assalamu alaikum, everyone. Thank you again for joining us here today. So far, you've heard about from Aliredha. He did an excellent job telling us what inflation is, how we measure it, and whether we are experiencing inflation in the economy right now. We also talked a little bit about the Fed's policy stance when it comes to targeting inflation. And in this portion, I'm going to focus a little bit more on the expectation going forward and whether there really is any cause for concern with regards to inflation. Also, I'm sure as most of you, as investors or, for anybody else, might be thinking about how you can position yourself in this current environment or moving forward. And those are some of the areas that we're also going to be diving into. So you heard quite a bit about this, whether, you should be worried about inflation or not. And I think most economists and Fed officials think that the current period of high inflation is transitory or brief in nature. This is a word that you have, heard about quite a few times by now, but it basically means that, they think inflation is going to be temporary. And their theory is that the current inflationary pressures are just a result of the loose monetary policy as well as the loose fiscal policy combined with some of the supply imbalances that were brought about by the COVID pandemic. And Aliredha kind of touched upon the base effect that we have been hearing about so much in the news. And much of the expectation surrounding this idea of transitory inflation is stemming from the fact that there is this base effect. So the base effect basically relates to how the economy looks now compared with a year ago. And many of you recall that around this time last year, the economy was hit with the worst of the COVID pandemic, and inflation was unusually low because the economy was mostly shut down. Therefore, Fed officials are suggesting that the current inflation measurements may in fact be an exaggerated snapshot of the price pressures, because we're coming from a deflated or weak base that was there in April of 2020, when prices sort of plummeted and because of collapsing demand for goods and services. So then where do we stand? Of course, we don't have all of the answers. We're just, kind of trying to point everybody, to the right direction. So I think there is kind of widespread consensus from the Fed at this point that the reopening of the economy will release a surge of pent-up demands, and supply bottlenecks that we have been experiencing so far will eventually go away. And as things get back to normal, inflation is expected to settle down later this year around the 2% range that was targeted by the central bank. Now, regardless of whether inflation settles down later this year or it gets prolonged, I think it's only fair that, it's beneficial to discuss some of the strategies that, one might want to consider for investing in this type of environment. So first of all, I think one of the ways to beat inflation is investing in disruptive technologies or industries, because they're considered a deflationary force. And what we mean by that, so technology is considered a deflationary force. And you heard the term deflation, which basically means an average decrease in price levels. So technology is considered deflationary primarily because it allows the production of goods and services to scale efficiently. In other words, technological improvements lower production costs because they lead to automation, and they also increase the speed at which goods and services can be produced. Therefore, it becomes easier to satisfy market's demand for particular goods. And if the supply of goods can always meet demand, then there really is no room for price increases, generally speaking. Therefore, innovation-based deflation is more likely in the next 5 years, and it will significantly benefit investments in innovation strategies that are making use of innovative strategies. Now, I understand that all this talk about deflation may seem like the farthest from our radar right now. I just wanted to note that we're actually already witnessing the impacts of production scaling in industries ranging from healthcare, biotechnology, electric vehicles, etc. For example, there's been a tremendous advance in DNA sequencing in recent years that can lead to lower healthcare costs. And then that will impact prices in 20% of the economy. Potentially, it will bring deflation to the healthcare sector, where costs, as you know, have risen steadily over the past years. And from this, you can get a sense of the good deflation that can be brought about by disruptive technologies, and how it will benefit those companies that embrace innovation. So positioning yourself and your portfolios in that way, where you're taking advantage of innovative and disruptive companies, we think might be a good strategy to be able to beat inflation. And next, commodities. Okay, so commodities are a type of real asset, things such as grains, crops, raw material, or natural resources, and they're often used as inputs into other processes. And commodities are a valuable inflation hedge because their prices typically rise when inflation is accelerating. And as you can see from the graph on the right, real assets tend to perform really well during periods of positive inflation surprise, which is inflation in excess of what is already reflected in the price of assets. Um, Natural resources, commodities, real estate, all these things tend to do really well, whereas bonds tend to suffer quite a bit when inflation is accelerating. And the reason that commodities tend to rise and become more valuable in positive inflation environment is because when the demand for goods and services increase, their prices go up, right? And this increase in the prices of goods and services then get transferred or reflected in the price of commodities that are being used to produce these goods and services. Therefore, even if the purchasing power of the dollar falls when inflation is on the rise, commodities hold their value due to their importance in everyday life. And in addition to commodities, precious metals such as gold and silver have long been considered an inflation hedge. And as physical assets, as real assets, they both have intrinsic worth, unlike the dollar or other currencies. So they can be a very good safeguard against inflation as well. And we consider all of these different asset classes in our portfolios. Now, REITs in general are an excellent inflation hedge. Real estate, as we all know, because much like commodities, land and property values also tend to rise alongside inflation. But if you are somebody who is interested in investing in real estate, but you're not ready to buy actual property, you can still invest in real estate through a real estate investment trust, or REITs as we know them. And REITs offer a built-in inflation hedge because the owners of apartments, hotels, office buildings, shopping malls, whoever is in the REIT portfolios can often pass on the rent increases at times when inflation is running up, which in turn will enhance the REIT payout as well as asset prices. And Sharia compliant investors can get exposure to this segment via SPRE, which, as you can see on the graph on the right, as of June 12, 2021, had a year-to-date return of 17.7%, apart from a dividend yield of 3.37%. So it's just capital appreciation. It was this REIT was launched in December of last year, and alhamdulillah, it has done quite well. And during that same time frame, you can see that it also exceeds the performance of the S&P 500 ETF or the SPY. And lastly, I think you want to be able to remain invested as opposed to sitting on cash, right? That's a great strategy to beat inflation, because rising prices means more profit for companies, which in turn boosts share prices. And they are gonna transfer that to investors. So historically speaking, and as this graph demonstrates, over the long term, the stock market has produced 9 to 11% of annual return on average. Now, even after subtracting the cost of inflation, the average annual return still beats inflation for the most part. Therefore, getting exposure to the stock market, either through index funds or individual stock picks, can be a great way to diversify your portfolio and hedge against inflation. Index funds such as SPUS can give you exposure to a broad basket of stocks at a much lower cost, and historically has done quite well when you look at its performance. Its year-to-date performance is standing at 10.24%, and since inception in 2020, it has had an annual return of 26.9%. Um, I think this concludes our presentation for inflation. We will now open it up to Q&A if anybody has any question.
Thank you, Rezwana, for presenting that. I'm sure everybody found it very interesting. And like you said, that brings us to the end of today's webinar. Let's see the questions that we have. I'm going to read out the question that we have here. Assalamu alaikum. Very good presentation. In these circumstances, what will you say about gold? Buy or sell our positions since the Fed does not recognize inflation, saying repeatedly it's transitory. Jazakallah khair. I think y'all did talk about gold a little bit, but maybe someone can answer it.
I think that as a general thing, as Rezwana mentioned, gold and silver, and we don't usually look at these holdings or investments in any kind of short-term time frame, just given that things can go up or down, as you have seen in the market, and majority of the time it's related to supply or demand. But with regards to the gold holdings or silver, I think that as a general position in a portfolio, yes, it can play a role. Sometimes it may not necessarily play the role of the hedge, and part of that has been affecting gold. If you've noticed the trend following some of the peaks that we saw last year in 2021, it's not, there was a period where it was really not doing a whole lot, but it has kind of since bounced back because people are slowly turning to other digital, non-standard currencies like some of the cryptocurrencies, and that has taken some of the demand away from gold. But as a long-term thing, yes, things like gold or silver could hold. And aside from that, if you think of commodities, to include things like copper, zinc, aluminum, and other metals like that, steel, right? These are all things that can hold value, especially if there is expectation of an infrastructure stimulus bill that will spur a lot more of that demand. Then that's another way that investors could consider some of those areas as well. So hopefully that answers the question that the person had about gold.
Thank you.
Yeah.
Thank you, Ali, for answering that question. There's another question here which says, apart from SPRE that Rezwana mentioned earlier, the REIT, and SPUS, do you have other investment recommendations to diversify?
So with regards to investment options, Rezwana did mention that individual stock picks could be a great way to complement some of these passive funds. And at ShariaPortfolio, we believe in a more well-rounded portfolio that looks at the benefits of what some of these passive funds can offer, as well as some of the individual stock picks in some of the areas that do offer disruptive, innovation, for example, or other areas. And again, each portfolio can vary. Some investors are concerned about preservation of capital. Some investors are concerned more about growing their portfolio. So the holdings can vary. So, a specific recommendation for one person may not be the best for another person, but as a general thing, if you are looking to be more of a income oriented and more conservative investor, looking at something that might be more dividend yielding might be a little bit of a better choice as compared to something that's just growth oriented, for example. So again, technology, healthcare, among other segments that offer opportunities are out there, and you can always discuss the specific ones with your advisor. There's obviously, from an asset allocation perspective, sukuk is another key element that investors may consider within their portfolio, which is the bond component, right? The Islamic bond is referred to as sukuk. And so investors who want exposure to that can benefit from ETFs. There's mutual funds that offer that as well. But that's something that again is available for investors to consider. And again, we're happy to discuss those with anyone that would like more information. Otherwise, you're also welcome to visit SP Funds website, which is sp-funds.com. If you're looking to buy any of these on your own, there's information there, prospectus and other things that you can review. But if you're looking for a more consultation with an advisor, we can always look at your specific situation and see what might work best for you. So hopefully that addresses the recommendation question.
Thank you, Ali. There's one more question. I think you did touch upon that point a little bit, but I'll read the question. What do you think about investing in crypto?
So cryptocurrencies in general are an area that can be seen by investment, analysts that offer some potential as a hedge against inflation as well. So I know we didn't talk about it because there is a disagreement, or there is less information available on the Sharia compliance side of things. However, there is a discussions happening, and some of these areas could open up, and again, something that works for one, and whoever does invest in that space should be aware of the risks that are involved, because these are the decentralized currencies can offer growth, but also have the potential for losing value, especially if there is any kind of hacking that happens, or if the value, or if there is any regulations that come about that could affect that space. So those are some of the risks that might be involved in that space. So I think that it can present some opportunity for the more growth aggressive oriented investors. And we've seen a lot of people who are previously on the fence about these kind of coming out and suggesting that there is a place for them, like someone like Ray Dalio, who is a well-respected hedge fund manager. Not too long ago, he used to be of the opinion that something like Bitcoin would be an area that investors should avoid. And again, Warren Buffett, who is the same person I quoted earlier in some of the items I talked about in the presentation, he considers it rat poison squared. So again, I don't want to promote something like that, but I do want to give the differing opinions. Someone like Ray Dalio, who was previously on the edge, now stated a little while ago, about a month or so ago, he stated that portfolios should consider up to 20% allocation in something like that. So it's still in the early stages. There's a lot of risk involved. But again, talk to your advisor and see what might work for you. And we're happy to discuss it one-on-one with any investor.
Thank you, Ali. I think that brings us to the end. We don't have any more open questions remaining. So
I think if there is an area that you want to put any other remarks from anyone, we can always add a little bit. But what I do think might be important to highlight is, inflation and topics like these are, we try and do as best as we can to present information that we think is going to help investors in their journeys, right? Because investing is about the journey. It's not a race. You're not trying to get to your destination in a span of a week, right? You're going to go through some of these ups and downs, and it's our job as investment advisor to kind of think about what are some ways that you can navigate some of the challenges that that come about, right? So last year there was a lockdown that was happening, and investors might have been thinking, well, what are some ways to benefit from that in my portfolio? What are some themes that might hold? So as a company, we often look at themes. We look at asset allocation. We look at the individual stock selection, and that is so as to make life easy for those who may not have the time or interest. But those who do want to invest on their own, we hope that the information that we've covered will help you in some way, shape, or form in making some decisions about what you may consider investment. At the same time, if you do find that this is an area that is quite difficult to navigate, or that you do not maybe have the time or the interest even dive into the dynamics that we mentioned and this is just one aspect of how markets might might get affected, but there are other things that could come up, and it's our job to inshallah break it down for you all. And you can always set up a consultation with one of our advisors, and we can discuss ways that we might be able to help add value in your financial journey. Do we have anything else, Shafak?
No, thank you, Ali. I just wanted to mention that if you did register for this webinar, the recording will be emailed to you, and you can also find the recording of this webinar and our past webinars on our website. So with that, we will end.
Someone asked a question. I'll just address this.
Oh, okay.
I think, what is the minimum amount to invest in SPRE? And so SPRE or any fund that's out there, if you look at the ticker symbol, it will tell you what it's trading at. So if you ever open any brokerage account in platforms like TD, we use, by the way, TD Ameritrade to hold our clients' assets as the primary custodian. But if you use any other brokerage platform, you can always go in, take a look at the symbol, and it'll tell you what the price is trading at. So you can always check that out. But SPRE, since he's asking, it's trading at around $23, $24 kind of per share. So it's relatively, very affordable for an investor, and it gives you broad basket exposure to REITs that are globally diversified as well. So hopefully that addresses that question. And for those who did not attend this, I know someone asked, is there going to be a recording? Is this going to be shared? Yes, this will be made available. You can always access past recordings on our website, ShariaPortfolio.com. There is a media section where you'll be able to see it there once the recording has been processed. Otherwise, if you have registered, then normally you'll get an email if you're on the newsletter with information about that as well. So hopefully that addresses that. Sorry, Shafak, I noticed those and I wanted to quickly mention something.
No worries. So I think with that, we'll bring it to an end. And thank you, everybody, for joining us tonight, and have a good rest of the evening. Thank you, Aliredha. Thank you, Rezwana, for that presentation. Assalamu alaikum.
Thank you, Shafak. Assalamu alaikum.